Welcome to NYSE Amex, NYSE ARCA Options webcast on collar protection for volatile markets. I am joined by the always irrepressible Amy Farnstrom, and I'm your host, Todd Weilman. Welcome to our webcast. Quick little housekeeping. Here's our legal disclaimer. Now remember, this is only for education and illustration purposes. We're not going to make any forward-banking statements. We're just here to educate you on our wonderful collar protection at the NYSE options exchanges. Moving right along, a little housekeeping. If you want to make the slides bigger, there's a magnifying glass icon at the bottom right of your bottom corner right of your computer screen, and that will make the slideshow bigger. And also, if you have any questions can be entered at the bottom of the screen. Please start sending those questions in right now. We will have a question time at the end of the show. So our agenda today is we're going to be talking about, obviously, collar protection. We'll do an overview. We'll talk about the variables of the collar protection. We'll talk about some processing rules. We're going to show you an example of it in action, and then we're going to take your questions. Send those questions in throughout the webcast, and there are no bad questions. So if you have a question, somebody else will also have that question, so send it in. And now, on to the show. So here's our overview right there. Realize that, Amy, when for the collar protection to come into play, there's going to have to be some actual instances where it's going to have to come into play. You're going to have some order imbalances. You're going to take over for a second.
Absolutely. The collar protection is for specific circumstances. So when we say an order imbalance coming out of an auction, we run an auction to open a series if there are orders that are locked or crossed, or orders in quotes that are locked or crossed. And unlike an opening rotation where you wait until you can get a one price cleanup for everything that's locked or crossed, we open what we can at one price, and then we might end up with an imbalance to buy or sell. In these circumstances, we recognize that we want to give clients a really good price at the opening of the day, and give their market orders that they may have in, before the auction some dynamic price protection. Another time when the collar comes into play is an incoming order arrives here and the market is wide intraday for whatever reason. The third instance where collar protection is useful and necessary is if we get a large order and as a result of executing some portion of that order, then the market widens out. We don't immediately reach up and trade at some undesirable price. We protect them with the collar.
The collar protection comes into play.
Yeah.
I like that. So now I see this in blue. Our trade desk has a capability to adjust settings on the fly intraday.
That's right. The collar can be turned off at any time by the trade desk. This really isn't done anymore because of some enhancements we've made, but in the past we might keep it on for the first 20 minutes of the day and then turn it off. And we'll speak about why we're confident to leave it on for the entire day now. The other thing that the trade desk can do is oftentimes before the market opens, this morning being one case where the indicators are sharply in one direction or another, which leads us to suspect that the market's going to make some big moves on the open, and clients can request a double wide or triple wide setting to trigger the
collar protection.
Yeah, well, it's not necessarily on the collar protection. It's on the quote width that's required to open a series, right? Because we don't open a series unless there's a legal width quote or NBBO there to ensure that our options are going to be transacted at a fair price. So along with widening out those legal width trigger parameters, the collar also widens out. Okay, so yes, and currently it can be sent to the default obviously is 1x of the values that we see on this slide. It can also be set to 2x, 3x, really any multiple of these values.
Okay. So now if the markets are within these ranges that we see on this on the chart below, 0 to 199. If the market's within 25 cents, it's a normal legal width market. There's going to be no collar protection on. But once the markets go wider than these widths, then the collar protection is going to be on, and it's going to come into play and protect the orders.
That's right. Absolutely.
Excellent. So a couple of important things to remember is we obviously don't calculate the theoretical price of an option should be in a wide market. We don't do that calculation.
No, I mean that's the beauty of having a market maker driven industry,
Mm-hmm.
is that the market makers run all those calculations and come up with fair value, and their prices are based on that fair value. We don't have any system sitting in the background trying to calculate that. That's something that our liquidity providers do for us and for the customers that interact with the marketplace. So what we say is, if the market is zero bid at $5, we as the exchange have no opinion of whether the theoretical value of that order, or excuse me, of that series is 20 cents or $4.90, right? So when the liquidity providers are displaying a wide market like that due to market circumstances or whatever, we say we are not going to make a guess at what the fair value of that market is at that time. And so because of that, for market orders that arrive, let's say the market is zero bid at $5 and a sell market order comes. Back in the past, certain market centers, and I believe some still do today, would just automatically post that market order at a nickel. And then it gets traded at a nickel, and then the market after is, a $3.20 bid. And so obviously that's not desirable. So we are more conservative than aggressive with market orders when it comes to these wide markets and where we post them.
I like that. And limit orders are only going to receive a collar protection if the limit is priced through the bid or offer of our own quoted market.
That's right. I mean, we don't make any assumptions. If somebody sends us a limit price where they want to execute, and it's within our quoted market, however wide that quoted market is, we are taking it that they know what they're doing.
Right.
They're sending us that limit price for a reason. The one exception to that is if there's already a market order that is held at a collar price, and we'll get into that in a little bit later. But if the market's zero bid at $5 and somebody sends us a $4 limit order to buy, we're going to post it paying $4.
Totally makes sense. Customer's always right. Moving on to the variables, the discrete variables of collar protection. So there's a couple of components that go into figuring out and how our collars are actually going to work. And the one big thing, I guess, is the collar timer.
Yes, right. I mean, what we do with all of the functionality here at NYSE is we constantly are looking for ways to refine what we're doing to give better protection and more dynamism and more choice, for our clients. And the collar protection is no exception. And we're still in the process of refining it. We'll talk about that in a little bit, right? But one of the things when we first implemented the collar protection, and I spoke to this a little bit earlier, how we turn it off a little while after the opening. That was because, let's say the market goes, not extraordinarily wide, but it's two bid at $2.60.
A little bit wider than a legal width market.
Right, and it's there for quite a while. Well, if you have a market order come in and it posts one collar up, $2.40, right? I'm sorry, it's got to be like two bid at $2.90. Still not a horribly wide market. We have a market order come in and it posts paying $2.40. It's going to sit there, right? And so then you run into the situation where somebody's going to say, well, I want that collar protection, and somebody else is going to say, I wanted to pay $2.90. Why are you holding it at this collar? So what we did was we implemented a timer, which really complements the collar protection that existed prior to that by introducing a level of dynamism that wasn't there before.
Keeps it dynamically active, and you're just not sitting there missing out.
That's right. So when we say that, I guess we should probably explain what that means.
Right.
Right. So The duration of the timer that's associated with the collar is 1,000 milliseconds, and we can adjust that. Everything, we try to make everything configurable so we don't paint ourselves into a corner. It's adjustable on, settings of 250 milliseconds. So it could be 750 milliseconds, it could be 1,500 milliseconds. Right now it's 1,000. So what happens is the timer will wake up every 1 second and kind of poke the matching engine in the ribs and say, has anything happened? Has the market moved? Has there been a transaction? If nothing's happened, then maybe we're not at the right price. Maybe we're not aggressive enough in the market. And so in that case, it moves it.
Makes a decision, and it moves it up another collar.
That's correct.
Okay. So, and some of the things that are going to move these things are if the same side as the order moves, either by a market maker quote or an away best bid or offer, then it's going to move the collar protection. Or if the same side order arrives, it will move it up along with that order.
It will, and those two things work in slightly different ways. And I know you've got some slides coming up where we're going to differentiate between those. Yes. Okay.
And then, of course, on the contra side, whether we have an update on our market or away markets. And then, of course, on an option for a market order, if there's no bid in the series or no, so we have different case situations. And
Absolutely.
We'll get to those.
Yep.
Also, something to look forward to shortly.
All right.
So going on to our parameters and processing rules. So the first
Oh, I apologize. I messed up on the slides here.
Oh. Where did that slide go?
Yeah.
There we go.
If anybody can mess up a slideshow, it's me.
Or me. So here's the collar parameters. Obviously, the collar is off the price of the option or the last price of the option. And so you see the option premium and then the collar width that we're going to assign or the collar amount.
That's right. I mean, we want to keep this sensible for, in relation to the premium, right? A $1 move in an option that's greater than $20 is appropriate. It would not be appropriate in normal circumstances for an option that's trading $1, obviously. Right.
Obviously. So that makes sense. And then, so some of the processing rules. So if you have a new same-side market maker quote or the away best bid or offer moves, it will move the imbalance. It'll move what the collar protection. It'll move it ahead regardless of the collar value.
That's right. So if we have a scenario where we're zero bid at $5 and we're posted at $4.60, one collar down from $5, we're going to be monitoring the market, but if a market maker quote or an away BBO comes in at 80 cents, we're going to move everything down to 80 cents because, again, we're relying on the marketplace to tell us what the real value of that option series is, what the premium should be. And, obviously we don't want to move the market maker quote down. It's going to post and then leave an imbalance held at $4.60. So at that point, all bets are off. We always listen to the marketplace first. It's only in the absence of enough information from the marketplace that we rely on the callers.
Okay, that makes total sense. And then, of course, on the same side as our order is, for a limit order, it's going to trade to the collar or the limit price and move the imbalance up either the lesser of the aggressive limit price or the one collar based on further execution opportunity.
That's right.
So the matching engine's always making the calculation, can we execute it here? And that's within the 1 second, the timer limit.
Yeah, and for a limit order, obviously, if it's, the market is one bid at $4 and we've got something posted paying $1.25 and a $2 limit order comes in, it's going to push everything forward to $2. Right?
Right.
And because that's the lesser aggressive of the limit price of the collar. If we're one bid at $4 and we have something posted at $1.25 and $2 bid comes in, it'll push it to $1.50 because it's always going to be the less aggressive of the collar or the limit price. And I apologize, I think that's probably confusing now. So it's always the less aggressive of the two.
Okay.
Okay?
Okay.
And then, again, if the timer goes for another second and nothing happens, it'll go to $1.75, then it'll go to $2 in the next second, until we find that price that is the fair value price. And some people might say, well, why don't you just push it to the limit of the order the same way you would for a market maker quote or an NPPO update? Again, we rely upon our liquidity providers to make that determination.
Okay. That totally makes sense. That totally makes sense. So moving on to the next slide. So if we have contra side, oh, wait a second, market order. I forgot that. So if the same side order comes in to the marketplace, and so we have our one bid at 4, and we have the market order, and it's a buy order, and we're at 1 1/4, and then the same side,
another market order comes in, will automatically go to $1.50.
Okay.
Because that's telling us, it's telling the matching engine that buy-side interest is building up, and maybe we're not aggressive enough, right? If we've got more buyers coming in and sellers aren't responding, we're going to become a little bit more aggressive in the market.
Oh, that totally makes sense. I like this. A smart collar protection. Whoever designed this, you get a pat on the back. Okay, so moving on. So now if we have new contra-side interest come in, so let's say that there's an away BBO or an order quote arrives within the collar, the imbalance will move to trade or route with this, and that's automatic, right?
Yeah, that is. I mean, if obviously we've set this parameter where the matching engine is monitoring for any activity, and the requirement is we've got to trade with this within this collar. If something arrives, we'll go ahead and trade. And then again, we want to make sure that we make that decision of whether to move to the new last sale price or stay at the current collar price.
Okay.
Right? Because if you just automatically move to the last sale price every time, you would run into this cascading effect where, in effect, you've just destroyed the collar. Right? Because then it's like, move to this price, trade more, move, trade more, and then you're just moving to the last sale price as if there weren't any collar in the first place.
A vicious cycle, so to speak.
Which is exactly what we're trying to avoid.
Exactly. So now when we route out, this happens, it's an intermarket sweep order, ISO order, we will route out and we will post at the route price that we send out. If there's, so we're only going to route out what the volume is on the away exchange, correct?
Yeah.
And so if there's any imbalance left, we will post our order, or we'll post our imbalance at the routed price with the volume.
And it's the initial route price, because remember with distributive linkage, there can be several route prices. So we're not going to route out and then post at the most aggressive price. We're going to post at the most conservative price, because who knows what's behind those orders in the depth of book.
Right. So true. So we determine updated posting price for the imbalance after an execution occurs. You know, we move to post at the new last sale price, as you were talking about, and we continue to post at the existing imbalance price based on further trading opportunities out there.
That's right, just to keep it from running up the book or running down the book.
So I got a quick question. So on collar, once you have a collar width assigned, so let's say the option price that we executed was $2.30, so our collar is 40 cents. If we happen to move above $5, it's still always going to stay 40 cents.
Well, I think a better example of that is if we start an execution, say at $1.90, and within that collar, right? So from $1.90, your collar is up to $2.15. It's 25 cents.
Right.
So even if we trade $1.90, $2 and a nickel, we're still in that initial collar. We're still in that 25-cent collar. So even though we're trading at some premiums above $2, we're not then going to go 40 cents. Okay?
Better way to ask the question. Thank you. And it was a good answer. That's the answer I wanted to get. So once we give you a collar width, that's the one you get to keep. Timer for imbalances held at collar. So when there's no contra or same-side updates arrive to trigger a trade or a collar move, and the markets remain wide after that 1,000 milliseconds, then we actually move up the order.
That's right. We kind of say, Bueller, and if nobody responds, then we get a little bit more aggressive, right? Because we don't want to be the tree falling in the forest that nobody hears. We want, market orders are meant to be executed. We don't ever want to prevent a market order from executing. We just don't want it to run wild.
Yes. We want people to run wild, not market orders. So, yeah, well, okay. And then, of course, the conditions that end the collar, the market goes back to normal width, and then, of course, or the imbalance is exhausted, we execute up to their amount.
That's right. And then when, peace has regained its foothold, we go to normal processing, but again, the matching engine is continually monitoring for any of those circumstances we spoke of at the beginning of this presentation.
Okay, excellent. So, collar protection in action. So we'll do just a quick market order and go through this, and then we'll actually give a real-life example.
Yeah.
So we have an incoming market order is received. Initial MBBO market is not wide, and so the matching engine trades any volume up or down to the MBBO like on a normal market order. And then we'll generate any ISO intermarket sweep orders to away BBOs that are within the price, correct price. And then let's say during the initial transaction sweep, we're going to post the last sell price, but then the markets go wide, we've exhausted all the volume, and then we have a wide market.
Right.
And then that's when the timer starts.
That's right. That's right. So, you've swept everything away that is within the legal width parameter, and things have gone wide. What we do, and again, to repeat this, which is significant given kind of the looseness in the market that the ISO order type is introduced. We post at the initial route price. We start the collar parameter from there. So if we route ISO away like at $1.20, $1.22, $1.27, $1.30, we're going to post and start the collar from $1.20, right? Because we're still including those other prices. Those are still legitimate prices, but we're not sort of leaping in front of ourselves. Because if, those away markets refresh at $1.24, then we can route out,
keep routing out an ISO order. That totally makes sense. And then the collar value calculated from the initial last sale price.
Right.
Obviously the example there. And then, of course, if the balances any remain, the matching engine will start the timer and then the wake up for whatever the configurable time is, the 1,000 milliseconds.
Yep.
And keep looking for additional trading opportunities up one collar from that price.
That's right. And make the decision whether or not to move to the new last sale price or stay where they are. So, a second isn't all that long, but in today's world, a second is a good amount of time for the market to, if it's in an unstable state, it's enough time to allow quotes to refresh, away markets to refresh, while not inhibiting, so greatly the movement of the market order through the different price breaks.
Okay.
If it really should be doing that.
Okay. Excellent. And then let's go some order types. So you have the limit order, and there's it's a better limit. You're obviously going to post at the limit of and if the limit's through the contra price, you're going to trade or route versus the contra side, MBBO or BBO. And then you're going to post any remaining volume at that last sell price. And then from there, the last sell price, we check our collar value for anything available trading interest. And then anything trade or anything anything post away, we'll route.
Right. And again, what people should remember as well is that we do still have the 2 executable filter. So if somebody just really fat fingers something or gets the wrong series or whatever happens, and something comes in that's just through the market, we have parameters in place just right at the front door to reject that order back and give people protection on their limit orders. So that's always in place as well.
Excellent. Excellent. Good to know. And then for a market order, in a wide market, we're going to check the same side BBO, and we're going to be pricing of the market order will be one collar up from that same side BBO.
That's right, and that's important. And it's one collar up or one collar down, depending, obviously, if it's buy or sell. So, again, going back to the scenario where we have a zero bid at $5 market, kind of, the worst case scenario at that low premium, and a buy market order comes in, it's going to post a collar up from the bid, which is under $2, so it's going to be 25 cents.
Mhm.
If it's a sell order, it's going to post one collar down from the offer, which is
$5,
40 cents, right?
Oh, right.
Right, because it's between 2 and 5,
Right.
right? So it'll post down 40 cents, so it's at 460. So 25 cents up, at 460 down, and it will continue to move at those collar widths through the market.
So let's go. So, and you know, we say here, look one further collar opportunity for trading opportunities, see if there's anything available. So if we're, let's go back to our example, zero at $5. We're a market order to buy.
Yep.
Obviously, collar protection starts off, we start at a quarter, but we're looking up to 50 cents
That's
for
right.
any opportunities over that first second.
That's right. So post at 25. Is there anything there, or, you know, obviously if it's zero bid at 5, there's nothing there. But if
Right.
something comes in
Over
under
those
50
12
cents,
milliseconds.
right, then it will automatically trade against it. Otherwise, it will go ahead and move to 50 cents, right?
Right.
If nothing happens. Same thing on the sell side. We're posted at 460, but we're monitoring down to $4.20. If anything comes in within that parameter, it executes.
Aggressive but conservative.
Right.
I like that. Like that. And then, of course, we've talked about these last two things, but on this page. But, you know, market orders will reject, most importantly, if there's no reference price exists, market order arrives and there's a, you know, series already open, but there's no quotes, which would be interesting, say the least, if the series is open, or there's no BBO, there's no last sale price, then we're just going to reject the market order and send
That's
it
right.
back.
I mean, if there's no way to understand, you know, have any idea of what the marketplace is, you know, obviously in the best interest of the client, we just send it back to them. You know, we don't want to make any assumptions in that case. If something obviously is seriously wrong, if all of those conditions are present.
So now, collar protection is not going to happen for conditional orders. They're outside the bounds of collar protection.
That's right.
So,
I mean,
on the contra side, talk about a now order.
well, I mean, I want to say, you know, conditional orders are outside the bounds of the collars, because there's a definitive execution instruction coming from a client, which we're going to pay attention to. Always we listen to the marketplace. Always we listen to a client. If we don't have enough information from those two sources, that's when we implement the collar protection. But if a client is telling us IOC, obviously we're not going to hold it up anywhere. If they're telling us fill or kill, same thing. Now,
Right.
same thing. And all or none, you know, they go into a working process. They're not in the display process, so they're not held to the collar either. But on the flip side of that, you know, somebody might say, you know what, I don't care what the market's doing. I don't want your stinking collar protection, right? I just
Okay.
want to come in and trade. I want to do what I need to do. Send us a now order, right? A now order will go ahead and trade. It'll route out. It will get the job done for you, because that's what you're telling us you want to have happen. Okay, so that's always a good alternative for those that don't want that collar protection to be in effect. The important thing to note is that people who are held at the collar will not be affected by the activity or behavior of the now order.
Okay.
Okay, it's not going to push things and
and
go all
move things
crazy.
up.
Right.
It's not going to
Okay.
impact other
Yeah.
orders resting on the collar protection. I like that. So again, the collar settings are under the control of the trading desk, and they are able to disable the collars on the fly, intraday, on a per underline or a total global basis if you
Yeah.
want all your stocks to not have a collar protection. But an interesting thing that's coming soon, there's configurable collars on a percentage basis.
That's right. You know, earlier we were talking about always seeking to refine this functionality, as we do with all of our functionality. And, you know, we plan for setting the collars wider, but there are times when the market, you know, there's enough liquidity in the market. There might be bursts of activity, and markets might go wide, but then they come back together again, you know, where 25 cents for a $1 option might be much too aggressive. In some of the penny pilot issues, you know, that might be more aggressive than we really need to be to get interest to come back in on the other side. So what's exciting about the percentage basis collars is that, you know, 1X is 100%. and the trade desk will be able to go in any percentage above or below 100%. So that means they can go 120%, they can go 80%, 50%, 57%, 23%, whatever they want to do, and it will always be based off of those legal width parameters by premium, right? Mm-hmm. So that is held, the integrity of that structure is held, but it can be on a percentage basis. So this makes it much more dynamic for the trade desk. Much
more dynamic and much more helpful. I like that. So just a real quick example. So let's say your configurable collar is, your 1X is going to be 50%. The collar is 25 cents. It's going to be 12.5 cents, but we're going to round up for them. So
that's right, 13 cents. And so then it would be 13 cents, 13 cents,
26 cents.
13 cents, 20 cents, 25 cents, 40 cents, and 50 cents, right? Just half of the normal collars. Okay. Before we move on, one thing that I want to go back to, when we were talking about the conditional orders, the IOCs and whatnot, that's on the same side. So if we've got an imbalance held at a collar price or some market orders held at a collar price, and these conditional orders come in, that's what I was speaking to earlier. If these conditional orders come in on the contra side, obviously if an IOC order comes in and it's inside of that collar, we're trading it, right? So there's no prevention of anything trading just because the collar is in effect. Any order type that comes in within the collar where the parameters can be met of the conditions of both orders, we're going to trade it.
We execute it, we trade it. Yeah. I like that. So let's go to an example. So we're in a three-market world. There's ARCA, Amex, and the OA market. We have a market order to buy 600 options. Here's our depth of book. The order comes in on NYSE ARCA. We're at an offer of 108. We have 50 contracts at the offer. Here's our depth of book. We have 109. We have the 50-lot offered at 110. We have another 50-lot offer. So our collar setting is going to be 100% 1X. Market order arrives, and we trade the 50 for 108, and then we start sweeping our ARCA book and our OA BBOs up to 110, and this is concurrently, right?
Yes.
And so we'll get the 200 contracts.
That's right.
And then plus the 50 that we got initially. So that we execute 250 for those values, and then we leave an imbalance of 350 contracts. So the matching engine will post our original price that we're going to post the trade at, the imbalance at, is 108.
That's correct.
Because that was the first
That's correct.
trade price.
Yep.
Okay. So, and then the matching engine sets up a collar, and that's going to be 25 cents because it's under 199.
That's right.
And so, and if there's any imbalance that remains, and obviously it did, 350, then at the initial transaction price, we start the timer then.
That's right.
So, okay. And then every second, the timer wakes up, and then we start making the decision whether to move the collar.
Mm-hmm.
And that's looking at whether there's a same side order that's come in, whether a market maker order has come, market maker quote has moved up the market, or if there's some away offer, or if there's another order that's come in on the offer
either
side.
a same side event or a contra side event that's going to cause the timer to say, okay, we're at the right price here. We don't need to move up a collar. And from 108, it's going to be monitoring up to $1.33, right? And so this is one place where, I think, gosh, 108 up to $1.33, that's pretty aggressive. This is an example of where maybe, the 13 cents might make more sense. It depends on the issue, and what's good is that this is all configurable on the issue-by-issue basis.
I like that. That totally makes sense. And so every 1 second, the matching engine wakes up, scans, but it doesn't have to wake up to see trading opportunities. If there's a trading opportunity, the matching engine is not asleep.
No.
We just say it wakes up. But, every second it makes a decision on what to do with the actual collar protection price.
Right. The collar mechanism wakes up every second.
But if there's a trading opportunity that comes along after 300 milliseconds, we're trading it,
yes,
correct?
The matching engine never sleeps.
The
Between the hours of 9:30 and
4.
Eastern.
15.
Yeah, 4:15. Exactly. Yeah.
It never sleeps. I like that. So now, if a trade happens within the collar, in that 1 second, and there's another trade, but it didn't trade with us, we're not going to move the collar up.
That's right.
Because
we're at the right price.
I like that. Okay, perfect. And then the timer does not restart at each execution time.
No, it's a rolling second timer. It's not a transaction-based timer. So it just
good to know.
It's just there in the background counting off the seconds.
Milliseconds.
Yes.
In our world today. Okay, yeah. And then so we go on, and then now it's the same side of the ARCA CBO or MBO of the market order moves to a better price. The order will of course be pushed forward.
And the important part there is that it's always going to have price priority, right? Because the market order has top priority.
Because of price time, the time it came in.
Yep. Time it came in, and also market order beats any limit order,
right? Well, of course, right, and the whole food chain, yes. And then let's see here. We've already talked about most everything else here, but if the contra side away best bid or offer refreshes while the market order is posted with the timer running, and the away best bid or offer is at a better price or within the collar price, the market order will immediately route out.
Yeah, I mean, it doesn't apply just to local quotes coming into ARCA, or if you're being held at a collar on Amex. It includes all the away exchanges, and we don't, we always immediately route out if there's a better price to be had that's within these collar parameters.
Oh, I like that. So going back to our example, just to finish it out, I always like to finish out the examples. We have the imbalance of 350 paying $1.08. We're posted there at $1.08. The timer's running. We see the away market refreshes within 1 second. Let's say it refreshes in 500 milliseconds. There's 350 magically offered at $1.25. And we'll just route out an ISO, and we'll route paying that price of $1.25, and we'll take the 350 contracts, and your market order of 600 is done.
Yes.
I like it. What a great collar protection. So let's go over the review, and as we're reviewing, send in those questions. I know that Amy and I know Amy explained it really well, but if there's any more questions, please send those in now. Let's go right through the review. Your collar timer, it's 1,000 seconds. That's what we start out. Milliseconds. Not 1,000. 1,000 milliseconds, which is configurable by 250 milliseconds. Our collar settings, they're the same as the legal width. Coming soon, we're going to have configurable. You can do any percentage of that width. Markets must be considered wide for the collar protection to start to kick in. Right. And then once the collar protection starts, we post the balance of an order at the initial trade price, and that's the key, where we post it, where we generate the collar width. And
initial transaction price.
The initial transaction price. Remember that word. And then, of course, the collar timer tells our matching engine to wake up every 1 second, and that starts at the initial trade time also. Yes. And then matching engine will trade any imbalance automatically when the market comes into our parameters.
So yeah, I mean, in a nutshell, probably the best way to explain it is just to say we keep your order protected, your market order is protected, but in the market at a reasonable and reasonably aggressive price. So, we're pretty proud of this here, and I think that it's, certainly saved our clients some heartache that they otherwise would have been suffering. And, again, we're always looking to enhance the processing. We do have a release coming up in the short term for the percentage collar variables, and we'll keep you posted on that. I'm sure there'll be client notices, and we'll mention it again on a webinar when we have a 2-prod date.
Okay, excellent. Right. That's good. Well, I see that our questions time has come to an end. I want to thank everybody for joining us. Now, we will be posting a copy of this webcast on our website. And you can find it here. Either go to futures, go to nysc.com, futures and options on the left side, hit the overview tab, either Amex or ARCA, and then it's right under the education tab. Amy?
And obviously, as always, if you have questions, if you weren't able to attend the webcast live today and you're looking at it on the website and you want to contact Todd or myself with any additional questions or, ideas, anything like that, you're always welcome to reach out to us. Here's our email addresses. And again, as we try to say on every webcast, Brandy Peterson is always very happy to speak with each and every one of you. You can contact her at the trade desk. She is just a wealth of information and has a great personality to boot.
I totally agree. And one last thing, if there's anything you would like Amy and I to explain, anything that you've wondered about, if you have another topic for a webcast, we would love to help you out, and we could do a webcast for you. So we're here to help.
Yeah. One last thing, we're going to be putting together some webinars that are geared towards our friends in the technology part of the business, specifically to get into a little bit more technical detail with some specs and conversations in that direction. So, those will be coming in the next month or so. Please make sure that the right people hear about it. We'll do our best to reach out to the right audience, and, we'll see you out there.
That sounds good.
Have a great day, Todd.
Amy, you have a wonderful day.
Always a pleasure.
Always a pleasure. Everybody, have a great evening. Be safe.
Bye-bye.